The saying, what goes up must come down, seems to particularly apply to the stock market. But how do you determine when a downturn is due? Jim Lineweaver is here with a forecast for the financial future. Jim is a certified financial planner professional with the Lineweaver Financial Group. So welcome back to the show.
Thanks for having me.
So do you think we're due for a downturn?
Well, we could be, but it's not as easy as maybe predicting the weather because it's a little shorter in duration, but things in the stock market are unpredictable. And what we've seen since 2008, the recession back then, is that the market's up over 200%. And so we're getting to one of the longest bull run markets in our history. There's only 3 or 4 like this. And you're starting to see some things kind of go sideways, and there's some leading indicators that might just tell people to be a little cautious with their money right now.
Okay, and such as?
Well, one of those leading indicators is where people are kind of spending their money. So a couple months back, a lot of analysts downgraded the restaurant industry. And it was pretty much across the board. There's a couple exceptions, but you know, when you start to see a large category like that of where people are spending their money and they're starting to see some revenue and not as much attendance, it's just raising a warning flag to say, hey, is there something else really going on here? So nothing to panic yet, but there are some signs out there that say there may be a little caution out there. Now here in Cleveland, we've had a lot of new restaurants, and so everyone wants to go see those, right? Yeah, and all of a sudden, hey, it's where everybody's at, everything's got to be good. Right. Well, you might not be seeing some of those other restaurants that may have a little less attendance because of that. So overall, though, just, you know, raising a red flag.
Okay, so what do we do?
Well, what you really want to do is you want to make sure, like I said before, you don't panic. There was a recent study by Dalbar that looked at back over the last 20 years, and it's looked at investors' behavior. And it said basically the overall stock market measured by the S&P 500 had actually been up 9.85% on an annualized basis. But the average investor through a mutual fund returns were only 5.19%. So why is that? Well, the thinking is that a lot of people get their emotions involved in the portfolio. They panic at the wrong time, and unfortunately they're looking at more like the opposite of, you know, selling high and buying low, and it really causes almost a 50% correction in overall returns in a 20-year period of time. So it's something to really pay attention to and make sure you're on top of.
Okay, so, but shouldn't we do something, especially as we get closer to retirement, I would think?
Exactly. So what happens is, as we're younger, you know, you can take more risk because you can go through those ebbs and flows in the stock market and you don't need it tomorrow. Well, once you get closer and closer to retirement, it becomes a totally different story because now you have to rely on your investments for a paycheck to come in to support your retirement. So what you really want to do is have a good game plan. So you don't want the knee-jerk reaction, you don't want the panic. What you need to do is set up things like maybe automatically rebalancing or making money more conservative as you get into retirement, have different buckets of money so you can, you know, have a good emergency reserve. So if the market does correct 10%, we saw one last August, we saw a worst January on record ever since the Great Depression, and if the market's down, if you have ample reserves, you shouldn't have to panic, and therefore you can ride some things out.
Okay, so the bottom line, I guess, is when we're planning, to the extent we can, plan for ups and downs.
You got to plan for both, yes, and expect a lot of volatility between now and the end of the year.
All right, so understanding how the financial winds may blow can help you stock up on a plan to weather any market storm. If you need help battening down the hatches, give Jim a call. His number's next.
For more information, call the Lineweaver Financial Group at 1-888-313-4009 or click to www.lineweaver.net.